Imagine waking up one morning and realizing the money you trusted your entire life is suddenly not enough. Your savings look the same on the screen, but everything around you feels more expensive. Grocery prices jump, fuel costs soar, and people around you start to panic. News channels repeat one word again and again: collapse. This exact moment has happened many times in history, and every single time, human behavior follows a familiar pattern. When trust in paper money and financial systems starts breaking, people rush towards something real, something limited, something that cannot be printed overnight. This is where precious metals enter the story, not as a theory, but as a reaction driven by fear, survival, and logic. If you want to understand why gold and silver demand explodes during economic collapses, you must first understand how panic rewrites the rules of supply and demand. Before we go deeper, make sure you like this video and subscribe to the channel. It helps support long-form deep content like this and ensures you never miss upcoming stories that most people never hear about until it is too late. Now let's continue. Every major economic collapse begins with confidence. As long as people believe the system works, money flows normally. Banks lend, governments print, and markets rise. But the moment confidence cracks, behavior changes fast. People stop thinking about profits and start thinking about protection. Cash feels unsafe, banks feel fragile, and promises feel empty. Precious metals, especially gold and silver, are different because their value does not depend on anyone's promise. They exist outside the system. That single fact alone changes everything when fear enters the economy. During collapses, demand for precious metals does not rise slowly, it surges suddenly. Millions of people try to buy at the same time while supply remains almost fixed. Mines cannot increase production overnight. Refineries cannot magically double output. This imbalance creates pressure, and prices respond violently. What looks like a price spike is actually a trust collapse showing itself through numbers. Throughout history, whenever currencies weakened or failed, precious metals became the silent refuge. The story repeats again and again across continents and generations, and once you see the pattern, you cannot unsee it. To understand how powerful this pattern is, we need to look at what really happens when an economy collapses. It is never just numbers falling on a screen. It is people lining up outside banks, governments announcing emergency measures, and markets moving faster than logic. In these moments, supply and demand stop behaving normally. Demand becomes emotional, urgent, and irrational, while supply stays slow, rigid, and limited. Precious metals sit right in the middle of this imbalance. Take gold as an example. Gold supply grows only a tiny percentage each year. New mines take years, sometimes decades, to develop. When a collapse hits, suddenly millions of new buyers appear overnight. They are not traders looking for small gains. They are families, institutions, and even governments trying to protect purchasing power. This creates instant pressure. Prices don't rise because gold changes. Prices rise because money loses credibility. Silver follows a similar path, but with even sharper moves. Unlike gold, silver has heavy industrial use. During normal times, supply is already tight because most silver is produced as a byproduct of other metals. When economic stress hits and investors rush in, there is simply not enough silver available to meet demand. Dealers run out. Premiums rise. Paper prices disconnect from physical reality. This is why silver often spikes harder and faster than gold during crises. History shows this clearly. In times of stability, precious metals move quietly, often boring investors. But collapses flip the script. The same assets that were ignored suddenly become the most desired. People who laughed at gold before now ask where to buy it. Those who never thought about silver start searching for physical bars and coins. This shift is not driven by charts. It is driven by fear and memory. Humans remember pain longer than profits. As collapses deepen, something else happens. Governments try to restore confidence by printing more money, cutting rates, and injecting liquidity. Ironically, these actions often increase demand for precious metals even more. The more money created, the more people question its future value. Demand rises again, supply stays fixed, and prices push higher. This cycle has played out repeatedly, and we are only just getting started in this story. One of the clearest examples of this pattern appeared during the Great Depression. When stock markets crashed and banks failed, people quickly learned that numbers on paper could disappear overnight. Demand for gold exploded as citizens tried to convert unstable currency into something permanent. At the same time, governments faced a different problem. As more people demanded gold, national reserves began to drain. Supply did not increase, but demand multiplied, forcing dramatic policy responses. This is when governments realized that precious metals were not just commodities, they were anchors of trust. As fear spread, people stopped asking how much gold cost and started asking how much protection it offered. This mindset shift is critical. During collapses, price becomes secondary. Availability becomes everything. When demand spikes faster than supply, even small shortages trigger panic buying. This pushes prices up further, creating a feedback loop where rising prices attract even more buyers. What looks like speculation from the outside is often survival behavior from the inside. Fast forward to more modern times, and the same mechanics appear again. In the 1970s, inflation surged, currencies weakened, and confidence in governments declined. Gold demand surged globally. Silver followed with even more extreme price movements because the market was smaller and easier to overwhelm. As more investors rushed in, supply simply could not keep up. The result was explosive price action that shocked those who believed metals were outdated. Another important detail often ignored is timing. Demand does not rise evenly throughout a collapse. It comes in waves. The first wave is driven by smart money and institutions. The second wave comes from the public once headlines turn negative. The final wave happens when fear turns into desperation. By then, prices are already much higher and supply is stretched thin. This is why late buyers often feel priced out. Economic collapses expose weaknesses that were hidden during good times. They reveal how fragile financial systems can be and how quickly trust can vanish. Precious metals benefit not because they change, but because everything else does. As systems wobble, people instinctively reach for what has survived every collapse before. And this instinct, repeated across history, continues to shape demand and drive prices higher when it matters most. When we move into the late 1990s and early 2000s, many people believed economic collapses were a thing of the past. Technology was booming, markets were soaring, and confidence felt unbreakable. But beneath the surface, debt was quietly growing. When the dot-com bubble burst, trillions in paper wealth vanished almost instantly. Once again, demand patterns shifted. Investors who had trusted stocks alone started looking for balance. Gold demand began rising steadily, not in panic yet, but in preparation. Then came the global financial crisis of 2008, a perfect case study of how collapses fuel precious metal demand. Banks failed, major institutions collapsed, and governments stepped in with massive bailouts. For the average person, this was a wake-up call. If banks could fail and savings could be frozen, what was truly safe? Gold and silver demand surged worldwide. Coin shops saw long lines, online dealers ran out of inventory. Supply chains struggled to keep up. What made 2008 unique was speed. Information traveled faster than ever. Fear spread globally within hours. This caused demand for precious metals to spike almost instantly, while supply remained slow and limited. Mines could not respond. Refineries could not scale fast enough. The imbalance became extreme. Prices climbed sharply, but more importantly, physical metals became hard to find. Premiums rose far above spot prices, revealing a gap between paper markets and real demand. Silver showed especially dramatic behavior. Because it is both a monetary metal and an industrial one, supply was already tight. As investors rushed in, shortages appeared quickly. This pushed prices upward at a pace that surprised even experienced investors. The lesson was clear: in a collapse, size matters. Smaller markets like silver can move violently when demand overwhelms supply. As governments responded with stimulus and money creation, trust weakened further. Each new bailout sent a message that the system required constant support. That message fueled even more demand for precious metals. People were no longer just reacting to the crisis. They were preparing for the next one. And this shift in mindset is what turns temporary spikes into long-term trends. After 2008, many believed the worst was over, but something important had changed permanently. Trust had been damaged. Even as markets recovered on the surface, demand for precious metals stayed strong. Central banks, which had once been sellers of gold, quietly became buyers again. This was not emotional behavior, it was strategic. When institutions that control currencies start accumulating gold, it sends a powerful signal about long-term confidence in paper money. During periods of heavy money printing, supply and demand dynamics become even more distorted. As trillions of new dollars enter the system, the relative scarcity of precious metals becomes more obvious. Gold supply barely changes, silver supply struggles to keep up, but currency supply explodes. This widening gap pushes prices higher over time. What looks like appreciation in metals is often depreciation in money. Another major moment came during the pandemic-driven economic shock. Within weeks, global economies shut down. Stock markets crashed, supply chains broke, and uncertainty ruled everything. Demand for precious metals surged instantly. Dealers reported record sales. Some could not deliver physical metals at any price. This was not speculation. This was people reacting to uncertainty they could not measure or predict. What made this collapse unique was how fast fear translated into action. People did not wait for months. They bought immediately. Gold prices spiked, silver followed with extreme volatility, and premiums on physical metals soared. Even when paper prices pulled back, physical demand stayed strong. This revealed a crucial truth. In real crises, paper markets and physical markets behave very differently. As demand surged, supply constraints became more visible. Mines shut down temporarily. Refineries slowed. Transportation faced delays. This further tightened supply at the worst possible moment. When demand rises, while supply actually falls, price pressure becomes unavoidable. This is the perfect environment for sharp spikes. Economic collapses are not just financial events, they are psychological shifts. Once people experience one major collapse, they never look at money the same way again. Each new crisis builds on the memory of the last. This layered fear keeps long-term demand for precious metals alive, even during periods of calm, setting the stage for future spikes when the next collapse arrives. Another critical element in every economic collapse is government reaction. When systems start breaking, authorities rarely allow markets to reset naturally. Instead, they intervene. Interest rates are cut, money is injected, and debt levels rise sharply. These actions are meant to calm markets, but they also change behavior. Savers realize that low rates punish cash holders, while rising debt weakens currency strength. This realization quietly increases demand for precious metals over time. Supply, however, does not respond to policy. Gold cannot be printed, and silver cannot be created by decree. Even recycling takes time and effort. This is why each new round of stimulus slowly tightens the supply-demand balance. Investors who understand this don't wait for panic. They position early. By the time fear becomes public, supply is already stressed and prices are moving fast. Another overlooked factor is global synchronization. In past centuries, collapses were often local. Today, economies are connected. When one major economy struggles, the impact spreads everywhere. This creates simultaneous demand across multiple regions. When buyers from different countries rush toward the same limited assets, pressure multiplies. A gold coin or silver bar can only exist in one place at one time. As demand grows, market psychology shifts. Media narratives change. Precious metals move from being called outdated to being called essential. Analysts who ignored them begin discussing shortages. This narrative shift attracts a new wave of buyers who were previously on the sidelines. Once again, demand increases without any meaningful increase in supply. Price spikes during collapses are not random. They are signals. They reflect stress, fear, and imbalance. Each spike tells a story about trust leaving the system and flowing into something solid. Over time, these spikes form a pattern that repeats with remarkable consistency. Those who study this pattern understand that collapses do not create demand for precious metals. They reveal demand that was always there, waiting for a reason to act. As collapses drag on, another powerful force enters the picture: scarcity awareness. People don't just want precious metals anymore, they want them now. This urgency changes buying behavior completely. Instead of asking about price, buyers ask about availability and delivery time. When sellers say out of stock or weeks of delay, demand intensifies even more. This is how shortages feed themselves. Fear of missing out combines with fear of collapse, creating explosive pressure on a very small market. At this stage, we often see a disconnect between official prices and real-world prices. Paper markets may show stability, but physical buyers pay much more. This happens because paper contracts can be created endlessly, while physical metal cannot. During collapses, people lose trust in paper claims and demand real ownership. This shift drains inventories quickly. Vaults empty, dealers ration supply, and premiums climb higher and higher. Another layer of demand comes from institutions. Pension funds, insurance companies, and even sovereign wealth funds quietly increase exposure to precious metals when instability grows. These players move large amounts of capital. When they enter a market with limited supply, the impact is massive. Unlike retail buyers, they don't chase headlines. They respond to risk models, debt levels, and currency stability. Their actions often mark the transition from early demand to sustained long-term pressure. At the same time, mining companies face rising costs. Energy prices, labor shortages, and regulatory pressure increase during economic stress. This makes expanding supply even harder. Some mines shut down, others reduce output. So while demand is accelerating, supply may actually be shrinking. This imbalance is one of the strongest drivers of long-lasting price spikes. As months pass, people begin to accept a new reality. They stop expecting things to return to normal quickly. This acceptance locks in demand. Precious metals are no longer seen as temporary hedges, but as core protection. Once this mindset takes hold across society, prices rarely return to pre-collapse levels. The damage to trust has already been done, and the demand it created does not disappear easily. Another important aspect of collapses is how interconnected markets amplify demand for precious metals. In today's world, financial systems are tightly linked. A banking crisis in one country can ripple across the globe within hours. Investors and ordinary people see the instability and immediately look for safety. Gold and silver, universally recognized and portable, become the default choice. This global rush intensifies pressure on supply far more than local crises ever could. In addition, currency devaluation plays a crucial role. When governments print money to stabilize failing economies, the value of existing cash falls. People start to realize that holding currency is a losing game if inflation accelerates. Precious metals, by contrast, retain intrinsic value. This drives both short-term panic buying and long-term accumulation. Each new collapse shows the same lesson. Paper loses, metals hold. A pattern emerges where initial spikes attract attention and then secondary waves push demand even higher. Early buyers tend to be well informed or financially sophisticated, reacting to subtle warning signs. Later, mainstream media coverage and visible shortages trigger the masses. Once physical stock becomes scarce, panic accelerates. This is why timing is everything. Investors who recognize early signals benefit most, while latecomers often face steep premiums. Industrial demand also plays a role, particularly for silver. Unlike gold, silver is heavily used in electronics, solar panels, and medical devices. During a crisis, production may slow or supply chains break, making existing silver even more valuable. Investors compete with industry for the same limited supply, driving prices higher. This dual pressure, investment plus industrial use, can create dramatic swings rarely seen in other commodities. Finally, psychological momentum cannot be underestimated. Once a collapse erodes trust, the fear of missing out amplifies buying behavior. People who would never have considered precious metals suddenly scramble to acquire them. This social and psychological aspect feeds the economic mechanics, creating a cycle where demand keeps rising even when prices are already high. Each crisis strengthens the habit of turning to gold and silver, reinforcing a centuries-old pattern that repeats without fail. During prolonged economic collapses, another critical factor emerges: the interaction between physical and paper markets. Many people track gold and silver prices on digital platforms, assuming they reflect reality. But in times of extreme stress, paper prices often diverge from physical prices. Futures, contracts, ETFs, and derivative markets can remain stable, while real coins and bars are in short supply. Savvy investors quickly realize that physical ownership is what truly matters, driving demand for tangible assets even higher. This divergence also creates opportunities for speculators, but it primarily highlights one truth: supply is finite. Mines cannot ramp up production overnight. Refineries have limits. Shipping and logistics face delays. Meanwhile, global demand is surging from individuals, institutions, and even governments. This imbalance makes physical precious metals increasingly scarce, forcing buyers to act fast or pay a premium. Economic collapses also reveal hidden vulnerabilities in the financial system. Bank runs, currency devaluation, and collapsing credit markets remind people that traditional assets are not always reliable. Precious metals become a refuge precisely because they exist outside the system. They do not rely on a government, a bank, or a company's solvency. This universality makes them especially appealing when confidence erodes. Historically, these crises have a way of repeating in patterns. The 1929 crash, the 1970s inflation, the 2008 financial crisis, and even the pandemic-related market shocks all show the same supply-demand mechanics at work. Each time, fear triggers a surge in demand while supply remains rigid, pushing prices sharply upward. Observing these patterns can teach investors when to prepare, when to act, and why timing and availability are crucial. Finally, as fear turns into widespread awareness, long-term accumulation begins. People start viewing precious metals not just as protection, but as a necessary component of wealth preservation. Governments and institutions reinforce this trend by quietly buying and holding gold reserves. Over time, this persistent demand ensures that precious metals remain central to economic security during any future collapse, continuing a cycle that has lasted for centuries. As collapses continue to unfold, another layer of demand emerges: generational memory. People who have lived through financial crises carry the lessons for decades. They teach their children, families, and employees that cash can fail, banks can collapse, but gold and silver endure. This knowledge passes quietly but powerfully, creating a cultural and financial bias toward precious metals that outlives any single crisis. The result is a long-term, steady baseline of demand that always exists, ready to spike when the next collapse hits. Another factor is geopolitical uncertainty. Collapses rarely happen in isolation. Wars, trade disputes, sanctions, and political instability often coincide with financial crises. Precious metals are global assets, recognized and trusted everywhere. When local currencies falter or borders close, people turn to gold and silver as universally accepted stores of value. Unlike other commodities, they cannot be devalued by one country alone, making them highly resilient during multi-layered crises. Market psychology during collapses also accelerates demand. Humans respond to fear faster than logic. Early price movements, media coverage, and visible shortages trigger widespread buying. Social proof plays a role. When people see others stockpiling metals, they follow, fearing they might miss out. This behavior amplifies spikes, often beyond what fundamentals alone would suggest. Scarcity and fear feed each other in a self-reinforcing cycle. Supply-side constraints continue to matter. Mines take years to develop, exploration is costly, and refining capacity is limited. Unlike paper assets, precious metals cannot be printed to meet sudden demand. When economic collapse triggers global rushes, These physical limitations become painfully obvious. Premiums rise, delivery times extend, and even wealthy buyers may struggle to secure immediate physical metals. This real-world scarcity is a key driver of dramatic price spikes. Finally, economic collapses reveal that precious metals are not just a hedge, they are a lifeline. They serve as insurance when confidence in money and institutions evaporates. Demand is fueled not by speculation alone, but by a fundamental human instinct to preserve value. Every collapse reinforces this behavior, creating a cycle where trust in paper falls and trust in metals rises, a pattern that has repeated across centuries and continents, shaping markets and human behavior alike.